As we reflect on 2025, we're very pleased and proud of how Maco's investment platform performed throughout the year. Maco's balanced strategy delivered a 15.1% return. Our Canadian equity income strategy delivered 27.8%. Maco's opportunity strategy propelled itself to a 43% return. Our global equity strategy posted 14.8%, and our diversified income strategy returned to 3.2%. The year was certainly eventful, with several critical themes emerging that will shape the next decade for investors. First, a new era of trade dynamics. Second, thinking about risk in a changing world. Rethinking income within a steepening yield curve. Central banks reprioritizing from inflation to growth. And the continued chaos of the Trump administration. Let's take a little bit of time to walk through each of these themes, starting with the new era of trade dynamics. For nearly a century, the story of global trade was one of progressive openness. From the early 1900s through the late 20th century, tariffs steadily declined, enabling multinational supply chains, cross-border capital mobility, and unprecedented economic expansion. That era is now behind us. The post-globalization environment is being completely reshaped by shifting political alliances, increased U.S. political pressure, and a renewed embrace of protectionism as a policy tool. In this new regime, the global effective tariff rate has surged from under 5% to a sustained range between 10 and 15%. These are levels we haven't seen since the Great Depression. Once governments discover how tariffs contribute to fiscal revenue and national strategic leverage, they rarely reverse course. As such, a sub 10% tariff world is unlikely to return in this decade. Tariffs are no longer a temporary political tactic, they are becoming structural. This shift is altering global trade routes, supply chain architecture, and capital investment patterns. One of the most notable consequences has been a powerful rise in trade financing demand as businesses navigate more complex and costly cross-border flows. Over one-third of trade financing commitments have increased by more than 10%. Behind these frictions, however, lie new profit pools, new winners, and new investment opportunities. Deglobalization is not the end of trade, it is simply the beginning of a new map. So, how should investors think about risk in this changing world? Periods of uncertainty often trigger a flight towards perceived safety, especially cash and GICs. However, history remains unequivocal. Long-term wealth is never created in cash nor in locked-in deposit instruments. Those perpetually lag inflation and opportunity. Now, risk is not abnormal. Risk is a constant. Over my 16 years in capital markets, there has never been a year when investors were not faced with the climbing of some wall of worry. Successful investing is not about avoiding uncertainty, it's about allocating capital where uncertainty is mispriced. Now today, opportunity lies where sentiment has been the weakest, and where valuation and future growth potential align. Most notably, outside of North America. Europe stands out as a region undergoing meaningful self-reinvention. It's recognized its vulnerabilities, particularly around energy dependence, defense readiness, and technology adoption. Europe has embarked on an ambitious multi-year investment program. Although valuations have begun to normalize following the outperformance in 2025, the region still trades at a meaningful valuation discount relative to the US, and that discount is also paired with a credible growth trajectory. The PEG ratio, which measures the price relative to the earnings growth, is currently at its widest gap between Europe and the US in over 25 years. In simple terms, investors can buy the same dollar of growth in Europe at a materially more attractive price. For disciplined investors, discomfort and opportunity often occupy the same address. Another concept worth rethinking is how to approach income investing in a steepening yield curve environment. Those investors who are seeking income are facing a structural dilemma. Around the world, sovereign debt burdens are rising. Central banks are easing interest rates to support slowing labor markets, and inflation appears anchored in the 2 to 3% range for the foreseeable future. These dynamics increase the likelihood of a steepening yield curve. This means falling short-term rates paired with resilient or potentially rising long-term interest rates. In such an environment, long-term government bonds become less attractive as a defensive anchor. Instead, investors should favor high-quality investment-grade credit with maturities in the 3 to 10-year range. This positioning limits long-duration risk while benefiting from yield carry return potential. the natural capital gain that occurs as a midterm bond moves closer to maturity along a steep yield curve, effectively like a ball rolling down a hill. But bonds alone are no longer sufficient. Over the past 2 years, equity and bond returns have become more correlated. This has eroded the historical diversification benefit they provide. As a result, income portfolios must evolve and widen their tool set. Thoughtfully constructed solutions now blend corporate credit, mortgage strategies, stable dividend-paying equities, and private lending. The goal? Resilient cash flow without compromising that downside protection. Now, these strategies are equally as important in the context of central banks that are shifting from an inflation fight to the growth battle. Entering 2025, central banks were caught between persistent inflation and weakening economic momentum. An uncomfortable policy intersection for sure. By late 2025, the pressure began to ease as the labor markets in both the US and Canada slowed meaningfully, with job creation flattening and turning negative in several months. This shift allowed central banks to pivot toward growth stabilization, cutting rates, rather than inflation containment. Our base case sees continued rate cuts across North America through 2026. In Canada, we expect the overnight rate to fall from 2.25% to 1.75% by mid-2026 and 1.5% by year-end. Now, in the United States, we anticipate the federal funds rate falling from 4% toward 3.25% by mid-year and 3% by December 2026. This environment favors investors who are strategically positioned along the midsection of the yield curve. Moving along to the continued chaos of the Trump administration and some developments on the horizon. Namely, the 2026 U.S. midterm elections this coming November introduce an additional macro variable. Recent Democratic strength across historically blue states, California, New York, New Jersey, and Virginia, signals declining Republican approval momentum heading into the election. Since 1950, the president's party loses on average 25 seats and has gained seats in midterms only twice. Current expectations point to the Republicans losing approximately 28 seats, likely shifting House control to the Democrats. Market implications are mixed but manageable. Political gridlock has historically been equity market friendly as it limits the probability of extreme policy swings. However, uncertainty lingers around the pending expiration of the 2017 personal tax cuts at the end of 2025, which, if not renewed, would weigh on U.S. consumer disposable income. Corporate tax reductions, by contrast, remain legislated as permanent. In this context, investors should maintain U.S. exposure but express it selectively. Importantly, U.S. political risk strengthens the case for international diversification, one of the most powerful tools available to the modern investor. With many variables impacting markets and meaningful developments on the horizon in 2026, it's important to stay disciplined and focused. The coming decade will reward investors as long as they can separate noise from signal and discomfort from opportunity. The world is changing, but disciplined investing does not. The future belongs to those who diversify intelligently, lean into valuation advantages, and maintain a long-term mindset.